watching Stock Watch with me, Bright Kumalo, and joining me to unpack your stock-related questions today is David Shapiro from Sasfin Securities and Roy Mutooni from Sanlam Investments. Be sure to send those questions through via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X, aka Twitter at Business Day TV using the hashtag Stockwatch. Roy, Shapiro, there's been a shakeout in the market. I want to hear what you guys are telling clients. I'll start with you, Roy. Obviously, local market haven't been mirroring much of what's going on in global markets, except obviously what's happening in Southeast Asia with our exposure through NASPA's process, yeah? So are we lucky to be in SA stocks currently?
Well, the thing about what's been happening in the markets is it's been global matters all settling down. So if I start from there, I think things were expensive. We've known that they've been expensive for a long time. That in itself is not a reason for the sell-off. I think you've seen increased uncertainty. And then there's also a thing that people aren't talking about a lot, which is rising inflation in Japan, which is pushing interest rates up there, which is sucking a bit of cash there, taking out a little bit of liquidity, and then that just makes overvaluation a big problem. So the Magnificent Seven have sold off. The 493 ex Magnificent Seven have also sold off. And here what you've seen is, like you were saying, NASPA's process have responded to whatever else we've been seeing. And then the rest of the stocks, basically, results have been coming out not particularly impressive, not particularly good outlooks. So really not much good news out there. And I think that when you add all of that up, there's really no incentive for the market in aggregate to be rising.
Oh, no, awesome. Shapiro, what's your take or feel of the temperature of the markets? Because now we're back. We're back to big old Trump and U.S. markets. We're off about close to 10% on the S&P 500.
Well, where you've got somebody who you can't read from hour to hour, it's almost impossible to make a decision. I think yesterday was classic, where he responded to Canadian backlash, and all of a sudden bursts out, we're going to put up tariffs from 25 to 50%. I mean, not even thinking. And, I was just joking. It's like saying, okay, we're going to let off a nuclear bomb, and then comes back 5 minutes later and says, okay, we're only kidding. You can't do that as president of the United States. And I think no matter who you are, a businessman or an investor, everybody is just totally confused by his policies. You can't make sense of it. But I think what I liked about, what Roy said, I think we've seen the correction that we've been waiting for. And for me, that's a very good sign. I thought it would take longer, be stretched out, this kind of re-rating. But Bright, if you look at the Magnificent Seven, if you look at the tech stocks, they're now starting to look very attractive. Going forward a year of multiples that are in the early 20s, some of them are below 20. So I'm not phased out by that.
In the Magnificent Seven, only two companies, are giving people the jitters. It's probably something like an Nvidia, which is down about 22 to 25%, or Tesla, which is down a lot. I haven't checked that chart out. But if you're out of those, you're down about 7% on your Amazons. You're down about 7% on your Apples. So why would you stress about that? I wouldn't take that to heart. Anyways, gents, let's talk about stocks. I'm not going to ask you about outlooks and all of that stuff. That doesn't make any sense. We've got Marco Jean Blum here who says, hi, will you ask the panel if they still see any upside in mustard drilling? Roy, do you look at mustard drilling by any chance?
So I haven't looked at it recently, but I covered them some time ago. It's one of those very interesting companies. So they're not actually a mining company. They're a mining contracting business that has a very unique way of drilling shafts. So you don't make the shaft. They've got this boring machine. And the good thing about them is they earn dollars, costs are in rands, and they tend to have, and they're actually a global business. I think they were in South America and lots of African countries. The biggest problem with them is they're small and illiquid, and I guess that creates a lot of volatility. Danny, who runs it, fantastic guy. It was his idea. He's run the business incredibly well, but it depends on mining activity. And if mining activity in their areas grows and demand for their kind of drilling grows, then there's nothing wrong with it. It's very cheap at current levels. But again, that's just a function of people not understanding it being largely ignored, and their method of mining not being widely understood.
So, no, interesting perspective. Anything to add there, David? Mustard
You know,
Drilling.
it's holding up in a channel, which is a high channel, in other words, but it's not breaking out of that. It's a 2 billion company, which Roy correctly says you can't really deal in it. This is a Keith McLaughlin. He loves the stock, and there are a few other followers of small caps who really like the business. But, you know, unless we're going to see massive development in the mining industry and contracts giving, it just kind of goes sideways. So it's sad. It's good business, good skills, but too small. You know, too small to really make a difference. Yeah.
Yeah, and it does pay a decent dividend, but I don't know, man. It's an interesting company. We have another question here from Nyasha, who says, hello there. Is Balwin a buy, sell, or hold? Who wants to take that? I'm giving it to the volunteer. Balwin Properties, gents. Roy, I'll go with you again.
Go with Roy. I'll come back afterwards. Yeah, go.
So Balwin is one of those companies that, like David says, I think the retail investor absolutely loves because of the big volatility. But when you look at it, what do? They build residential concepts, and that depends. And how does that succeed? Availability of mortgages. People actually having the income to take up these mortgages and to move in. And what does that drive? What's that driven by? It's by employment. So in aggregate, for so long as employment is not growing, these companies struggle. I mean, it's quite clear it's a very cyclical industry. These companies go boom and bust relatively quickly. So you have to be very careful about their pipeline of orders in terms of what they're building, their balance sheet, and what the uptake is. And you have to monitor that very closely, because the end of one project might mean literally the end of the business. So yeah, it's one of those you have to be really close to invest in. It's a small cap as well. Nothing wrong with it, but a very cyclical, very volatile industry in a world where employment's not growing. You don't have significant migration happening. Over the medium to longer term, I wouldn't be particularly enthusiastic.
So you're not bullish on bricks and mortar?
Funny enough, they were up about 9% today, which made me look. But have a look at the chart. It goes one way. You know, just comes screaming down, and they're just not producing the profits. And I think Roy covered the background to that. They do these huge areas of build, and they do well. They maintain them, but
yeah. What if I ask you the question differently then? If they converted into a REIT and then they started working towards that path, would it make any difference?
I don't think so. No, they developers.
Yeah, remember they tried the whole thing of having a side business that was rentals. Now, it gives you a completely different risk profile. When you're a developer, what you do is you have deals with contractors and individual projects. When you own property, remember now you've got the capital cost on your balance sheet. On the one side, the asset, the debt on the other.
Yeah.
So now you're depending on rentals growing over time. Totally different market. When you're a developer, you move on from project to project. You can take a pause and do nothing. But when you own these things, you're the landlord. You manage it. There's a cost associated, there's an expertise associated with that, and you can't run away from it. So that's a completely different risk profile, I would say.
And Roy knows a lot about the small caps, hey? Perfect guest on the show.
No, fantastic. Quick question on Pick n Pay. It dropped about 17% since their highs, and obviously they've got a large shareholder. Is it something that will entice you at these low levels? David, sorry?
Bright, I've been watching all the retailers, and they've come under enormous pressure in the first 2 months. I think they ran ahead of themselves last year as we saw the GNU, load shedding, all those issues which were supposed to drive the economy higher. And yet the results that came out have been very muted. And I'm talking broadly among all the
consumer-centric. Yeah.
Yeah. And Boxer came out, yes, it gave them a bit of a lift. The gains in Boxer fed through to them, but we're starting to see an unwinding now as people become more concerned about what's happening in the retail sector. And remember, they're not operating from a strong position. They're trying to generate cash. They're trying to restructure. So I think that's one of the reasons that they're unwinding some of those gains.
Okay, David. So then, between the big box retailers, which one would you go for instead of Pick n Pay? Which one would you back if you had to buy a retailer?
I'd go for Shoprite simply because they're the best of the bunch. I know they're expensive and results were slightly disappointing, but I'm not in. I'm still very, as we opened the show, Roy mentioned the results are coming out and what we're seeing here. I don't think there's great opportunities in SA Inc. at the moment.
Yeah, it's very tough. Woolies is still on the turnaround, with David Jones, and there's quite a lot of things happening out there. But anyways, so I want to hear from you, Roy, whether you would, start picking up some Pick n Pay or Boxer, or I don't know, a very smart playing the two, short one, long the other. I don't know.
No, I think David got it perfectly right. It is so difficult. First of all, to restructure a retailer. Remember, these guys make margins below 5%. That's one thing.
Yes.
Second, you're restructuring a retailer when there's a dominant player who's just going from strength to strength, and that's Shoprite. And they've got all of these outlets at the different LSM levels and stuff. It's a tough market. So I think for Pick n Pay, your big benefit there is that you have an embedded value from Boxer, and then the bet you're taking on is how long they take to restructure this other business, the core business. But well, when times are tough like this, you stick with the incumbent. You stick with the guy who seems to know what he's doing, who's growing, who's taking up all the space, and who's got the adequate return. So I'll be with David here. I'll get into Shoprite and hide there because times are not easy for the consumer. It's a very competitive market. It is tough to stand out.
Yeah, no, thanks, Jan, for that question. We have Lenro here, who's asking about the banks, or the major banks, Standard Banks, Absa, Nedbank, etc. Is it not too risky to invest in these companies, seeing that the current US administration is pro-Israel? I don't know what that has to do with anything. And these companies are pointed to as collaborators to bankroll the ANC through Iran. So this is a little more politically inflamed question, but let's look at the companies themselves. Local banks. Your thoughts on local banks, Roy?
Look, the thing is, they're nicely diversified. That's one thing. They're huge. They're diversified across the economy. Some of them have operations in the UK, in Africa, and everything. So their risk profile is actually quite low. They pay solid dividends. They all started growing lending at the right point in the cycle. And as interest rates come down, they haven't come down overly aggressively. So they're still making a lot of net interest income as well. Nothing wrong with them. I think the valuations aren't stretched by any stretch of the imagination whatsoever. I mean, they could do with a better economy, but they're the perfect place to hide here. They're not carrying excessive risk. They're not carrying much risk, actually. The lending is very small as a proportion of the outstanding book. If you wanted a solid yield play with a potential of capital growth, I would do any of the banks.
Okay, I like that. And the numbers that have been coming out aren't too bad, because most of the bad loans and the individuals like myself who can't afford another loan, they've been put on the side. So they seem to be doing okay with their current client base. Do you have any comments on local banks, David, or do you want to take a very interesting and hard question? I think you should go with the interesting and hard question.
I'll go with the interesting, the hard question. But my view on banks. If there's no underlying economy, you can't grow. So Roy's right. They're boring. But they're as safe as a bank.
Okay.
That's it.
Okay. Let's take a question. Okay, let's take the hard question from Charles. It says Renergen has had a phenomenal week. You know, they're up over 80%. What gives? What does the market know that we don't know?
I have no idea. I looked at it today because they were up about 30%. You know, they came to the top of the list. This is a company that's market cap had fallen to about 600 million. So, I mean, the recovery is hardly a blip on the drop that we've seen in it. There hasn't been any news around. There's no corporate news following that. So this could be a player who's maybe heard something. It's not unusual for information. I don't want to say leak or accuse anybody, but you know, people like to talk about the stock. But I don't know what it is. I don't know whether there's any progress in the operation itself. It's suffered a lot of difficulty, and even to get it up to scale is going to cost a huge amount of money, which I don't think they could raise at this. Stefan, I don't think he could raise at this kind of moment, unless he's got something is going to come. But I still remain very cautious about the outlook for the operation.
Yeah, so it's a typical Moat Street, you know, buy the rumor. Okay, let's talk about another company here.
Roy, he's the small cap man. This is one that everybody watches.
No,
I'm not sure Roy has any more insight here. Roy?
No, I think David hit it 100%. This is one of those ones where who knows?
Who knows?
And you know, especially exploration companies, maybe somebody saw some helium being taken out of the plant or something and decided they were going to buy. It's impossible to tell.
Yeah. Look, that's a hard one. That's why I said I give the hard one to David. So, dear Stock Watch panel, I have now lost close to 60% of my investment in Aveng a few years ago. Do you think the stock is still worth hanging on, or it's going down the tube, just like Basil Reed? Oh man, this person has been through a lot, and clearly they are not learning. So, Roy?
I mean, Aveng is no longer a South African company. They're basically, they're exposed to, I think it was 3 contracts in Australia or that side.
Correct. Yeah.
And the thing about these contracting businesses is you just need one to go bad. You will go under. No questions asked. What he invested in 3 years ago is very different from now. Yeah.
Sorry,
I'm trying not to tell
laugh.
what they're going to do.
Sheep, yeah, no, so...
These things happen. It's a listed company. It was a giant company. I mean, David will remember when the combination Murray's...
LPA.
Yeah, they're all 30 billion rand companies, but not anymore. Things have changed.
I wonder where the value all went. So we have another
it's sad because they recapitalized.
Yep.
You know, they came down to nothing. They raised capital, went to Australia, and they're going the same way. The construction is so difficult.
Yeah, there's another Moat Street saying for you, David, that South African companies, you know, Australia is where they go to die. So take that for what it is. Yeah. So we have another question here from Lali Govender, who's asking us about Bell Equipment. She said she bought it at 48 rand 50. You know, when there were talks of a buyout, now it's as low as 38.90. Should she hold or sell? So this is another interesting one. Practical question where there's some action going on. David?
Well, they tried to take it out. They couldn't because they tried to steal the company at a very low value. And I think somewhere along the line, as we saw with Barlow World, they'll come back again, you know, in the right time and try to privatize it.
Well, this is not also the first time. It's the second time, right?
No. Second time they failed. Second time, and they're dying to take the company off the market. But you'll eventually get your bid at the right time. But against them, you're in an environment where there's nothing happening in infrastructure. You know, all the companies around it, whether it's PP Cement, whether it's the construction businesses, as we've seen now, even with Aveng, it's very, very difficult. So they need something really big to happen to get them into that position where they can make another bid for the company. So I don't know. It's these are hard decisions to make, you know, whether to hang on or to try and make your money elsewhere.
Yeah, no, but there's always an opportunity cost for holding out for something like that because most of the time it doesn't go how you think. From my experience, at least my personal experience, I've done all of them, Adapt IT, you name it. Here's an interesting one. So obviously there's a potential ceasefire between Russia and the Ukraine, and the US is playing negotiator, blah, blah, blah. So which companies, keeping in mind that the S&P 500 is off its highs, which companies would you look into buying, Roy, if the ceasefire goes as planned?
Two things. One thing you have to be is very cynical. A ceasefire is the first step towards rearming. That's the first thing. So the people you look for, and you have to rate this. So the first side is you look at the arms, the guys who provide arms and that sort of thing. And interestingly enough, there's Roynet here that actually supplies switches into military equipment. Then if you're on the optimistic side, you understand that after ceasefire comes the peace, and then you have to reconstruct the Ukraine. Clearly, those contracts will be spread out across all of Europe with some American companies and that sort of thing. So the person you look at then would be any of those big industrial companies in Europe, because they have to rebuild. There's a lot of engineering that needs to go in, and you can assure yourself it will be very well funded. I think that's the way to think of that. Obviously, there's second round effects around food inflation and all of that, but I think this is the easiest way to think about it. Those are the two angles that I think I would play.
Okay, so you like the bottom-up approach of look at the problem, what could be the potential outcome, then work from there backwards into, the individual names. I think we should go into our stock picks. I'll start with you, David. I see you keen on talking to me. So do you have anything to say about the ceasefire first before you go to your stock pick?
No, just remember the Halliburton scandal. Remember in the Iraqi war when what's his name? He was vice president.
Yes. In the George Bush administration, yes.
No, remember
when he had the interest in Halliburton, yes.
So anyway, but Bright, I'm going from Microsoft on the basis of when we, in the introduction, I'm looking at those, at the Magnificent 10, or certainly the big companies, the big tech companies. And I just think they're trading now at levels where their multiples are no longer that expensive. There's nobody there that can say that the PEs are high. And I think we're going to get a turnaround in those stocks. It might take a bit of time, but I can't predict exactly when it's going to happen. But I still like them, and I think. Sorry, I'm talking Alphabet. Why did I say Microsoft? I'm talking Alphabet because they're the multiples are below 18. I was going to qualify it by saying the multiples are below 20, and not Microsoft, but certainly Alphabet.
Okay, you are buying Microsoft, Alphabet, everything in the Magnificent.
I'm buying NVIDIA as well, where their 2-year forward is only 19. So
that's madness. That's a steal for a company that's growing at high double digits. Okay, you, Roy, he likes his tech. He's still sticking with the Magnificent 10, as he's called it. So the bluest of blue chips. Take Tesla. Of course, we all agree on that.
So I'm a lot more conservative. So I'm sticking with an interesting theme around asset managers, and that's Quilter. So this is an asset manager that's based in the UK. They've restructured themselves really well. They've invested a lot in their platform, and they're particularly useful in the UK, where now everyone actually manages their own pension. Not everyone has the knowledge to do that, so they train the IFAs and all of these people and give them the technology, and they aggregate the funds. I don't think it's expensive. I think they've come out of a big cap expense, so solid dividend yield, and I think good conservative growth over a period of time. That would be my pick for today.
So you're going with Quilter. So that's Quilter and, I don't know, a mixture between Alphabet and Microsoft. Thank you very much, gentlemen, for joining me this evening and answering these tough questions. That's all for Stock Watch today. Thanks to our guest, David Shapiro from Sasfin Securities and Roy Mutooni from Sanlam Investments. Up next, The Close. Stay watching.